Now let's address the systemic scarcity that defines his specific approach to investing in miners. The industry has been chronically underinvested for years. Exploration budgets have been slashed, and finding a truly world-class, multi-million-ounce gold deposit is becoming vanishingly rare. The average grade of mined ore continues to decline, meaning companies must process more rock for the same amount of metal. Sprott understands that the current gold price is not just a reflection of inflation, it is rapidly becoming a reflection of scarcity. Therefore, he is not interested in risky exploration plays. He is focusing on companies that already have established, proven reserves in the ground, assets that are literally irreplaceable in this environment. If you are still watching this, you recognize the gravity of the situation. We are not discussing merely hedging your portfolio anymore. We are discussing positioning ourselves for exponential wealth preservation and creation against a backdrop of global financial chaos. Remember, these are Sprott's top bets, the plays he has personally leveraged his corporate and private wealth on, predicated on the explicit expectation that sovereign debt will continue to spiral out of control, forcing central banks to allow real interest rates to plunge deeper into negative territory. His strategy focuses on exploiting the leverage inherent in small to mid-tier producers. He identifies companies that are currently undervalued based on their existing resources and production profile, but which are structured to see massive profit margin expansion when gold prices inevitably breach $2,500, then $3,000, and potentially much higher. He calls this the leverage trade, buying ounces of gold in the ground at a discount through equity ownership in producers, rather than paying the premium for physical metal today. This strategic focus leads him away from the massive, sprawling majors that are often inefficient and have high overhead. Instead, he zeroes in on the streamlined, operationally efficient companies that offer the highest degree of earnings leverage to price movements. We are talking about the sweet spot, the companies that give the highest return on capital when metal prices surge. He has identified 3 specific plays, 2 focused on precious metals and 1 on that essential industrial metal, that are uniquely positioned for potential tenfold returns over the next 6 years, all predicated on the fundamental collapse of global purchasing power. The time for passive investing, for trusting the centralized narrative, is over. We must adopt the Sprott mindset, protect capital from debasement first, and then relentlessly pursue asymmetric, high-leverage opportunities in the few sectors that actually benefit from monetary chaos. He has closed the loop on his analysis, stating clearly that the monetary crisis is unavoidable, and the only question remaining is which assets you hold when the inevitable correction occurs. We have established the macroeconomic context, the foundational crisis of debt, and Sprott's philosophical shift toward leveraged scarcity plays in silver and high-quality gold producers. Now, the crucial step, identifying the actionable names and the precise criteria for investment. If you found this explanation useful and you want to ensure you receive the second part of this indispensable breakdown, please subscribe to the channel right now, hit the notification bell, and leave a comment below telling me which metal, gold or silver, you think will perform better over the next 6 years. Your feedback drives this conversation. In part 2, we transition from the why to the what, diving into the explicit companies and strategic maneuvers that constitute Eric Sprott's top 3 bets for the remainder of this decade. Don't miss it. And the reality of the market dynamic is this: the easy money has already been made by those who recognize the necessity of owning physical gold and silver in response to the massive, unprecedented fiat currency expansion that began in earnest over a decade ago. We have navigated the early stages of this great repricing, but the true wealth generation potential, the 10x and 20x multipliers I am targeting over the next 6 years, resides elsewhere. It is located at the intersection of extreme scarcity, required industrial demand, and abject political neglect. We must now move past the general protection thesis and focus entirely on the asymmetric growth thesis. I believe the biggest mistake an investor can make right now is treating all commodity investments as a monolithic hedge. They are not. Gold is a currency hedge, silver is both a currency hedge and an industrial necessity, and then you have the specialized mission-critical elements, the ones required for the global energy transition, which possess their own unique, explosive supply-demand imbalance. This is where we focus the remainder of our attention, because this is where the capital will flow violently when the broader market finally recognizes the infrastructural cliff we are standing upon. The open loop that continues to frustrate and ultimately reward diligent investors is the lack of capital expenditure in the mining sector over the last 15 years. It takes 10 to 15 years, sometimes longer, to bring a major mine online, even a modest one. The political climate is hostile, the permitting process is glacial, and the operational risks are higher than ever. Now layer onto that the severe cost inflation experienced across every input required for mining: fuel, steel, labor, and crucially, energy. This cost inflation means the break-even price for nearly every base metal and precious metal has increased dramatically. This structural reality provides a powerful, often overlooked, underpinning to the long-term price floor. Supply cannot respond quickly, even if prices double or triple tomorrow. This lag is the source of our 6-year opportunity. Let's zero in on two specific sectors that I view not merely as opportunistic investments, but as mandatory positions for serious wealth accumulation in this cycle: silver, specifically the high-grade, undeveloped properties, and uranium, the ultimate energy transition bottleneck. First, silver. While gold remains my foundational currency hedge, silver is the leveraged instrument on both monetary debasement and accelerating green technology adoption. The gold-to-silver ratio, GSR, remains historically high, suggesting that silver is still fundamentally undervalued relative to gold. But the monetary argument is only half the story, and frankly, the less exciting half when discussing potential exponential returns. The real engine for silver's explosive move comes from the non-negotiable industrial demand. Solar photovoltaics, electric vehicles, 5G technology, these applications are massively silver-intensive, and their global adoption is mandated by state policy and corporate ESG goals, independent of economic growth cycles. The industrial demand for silver has been setting new records annually, yet global silver mine supply has been stagnant or declining. This is a critical structural issue. Silver is mostly produced as a byproduct of mining zinc, copper, or lead. When the supply of those base metals stagnates, the supply of silver stagnates, irrespective of its own demand drivers. We are entering a period where the global inventory of above-ground refined silver is being drawn down at a pace that cannot be sustained. When this realization hits the broader market, and institutional funds are forced to buy into a tightening physical market, we will witness a dramatic repricing. I am not talking about silver reaching its nominal high of $50. I am confident in seeing silver prices substantially higher, which will translate to immense gains for the best-positioned developers and producers. If this highly leveraged scenario resonates with your investment philosophy, I strongly encourage you to pause for a moment and hit that like button and subscribe to the channel. Your support ensures we can continue delivering this high-conviction analysis straight to you. My conviction is highest in those junior silver companies that control large, high-grade deposits that have been substantially de-risked but have not yet achieved full production. These companies offer the maximum leverage to a rising silver price, often trading today at fractions of their eventual value, based on current metals prices, let alone the inevitable cyclical peak. A $20 move in the price of silver can translate into a 5-fold or 10-fold increase in the equity value of a high-leverage junior miner. This is the asymmetrical return profile we demand. Now, let us turn to the final and perhaps most compelling bet, the one where the supply inelasticity is the most profound and the necessity is the most absolute: uranium. Uranium is the cleanest and most reliable dense energy source humanity possesses, and it is the only viable path for developed nations to achieve net zero carbon targets while maintaining grid reliability. The shift in global political and financial sentiment towards nuclear power over the last few years has been seismic. Reactors are being restarted, life extensions are being granted, and massive new build programs, particularly in China and throughout Europe, are underway. The conflict here is simple yet overwhelming. The demand for uranium is skyrocketing, fueled by long-term, non-negotiable energy policies, while the supply structure is fundamentally broken. Decades of depressed prices led to massive underinvestment and the closure of major primary mines. The current production levels are nowhere near sufficient to cover existing reactor demand, let alone the burgeoning new demand. The world's utilities have been drawing down inventories, essentially living off the fat of the land, but that inventory cushion is rapidly disappearing. When the utilities, realizing their profound future supply deficit, are forced back into the long-term contracting market, they will encounter a supply wall. Unlike gold or silver, the demand for uranium fuel is highly inelastic. A utility cannot simply switch fuels. They must have the fuel for their reactors, regardless of whether the price of a pound is $50 or $200. The cost of the uranium itself is a minimal fraction of the total operational cost of a nuclear power plant, meaning utilities will pay virtually any price necessary to secure supply and prevent a catastrophic shutdown. This structural imbalance, massive guaranteed demand meeting negligible, inflexible supply, creates the perfect setup for a price explosion. We are already seeing the initial stages of this repricing, but the true climax has yet to arrive. My focus here is on the primary producers and near-term developers who control significant permitted resources in stable jurisdictions. These companies represent the ultimate scarce asset. They are the only ones capable of providing the fuel the world absolutely must have. I foresee a period, well within our 6-year window, where the price of uranium achieves a triple-digit peak, perhaps multiples higher than today's prices, driven by extreme competitive buying among global utilities desperate to lock in multi-year contracts. The equity return potential for the best-positioned companies in this sector eclipses almost everything else in the commodity space, save perhaps for a few specific high-grade silver properties. In conclusion, our 6-year investment strategy must be rooted in the recognition of currency debasement, but the maximum potential for growth is found in the extreme supply deficits of mission-critical metals. We are exiting the era of cheap, easy energy and abundant resources. The mining landscape is shifting fundamentally. The majors are starved of Tier 1 assets, meaning they will have no choice but to acquire successful junior developers at massive premiums to their current market capitalization. The great wealth transfer of this decade is not merely from stocks to commodities, but from intangible financial assets built on debt and speculation to tangible, real, and scarce assets that form the very foundation of industrial society. Gold and silver protect your capital. Uranium and the leveraged, high-grade silver developers multiply it. We have provided a detailed blueprint for navigating the volatile years ahead, focusing on the highest conviction plays that Eric Sprott is personally pursuing. Do not let this information be passive. Use it as a starting point for your own rigorous due diligence. If you found the depth of this analysis useful, please hit the subscribe button right now and turn on the notification bell so you don't miss any of our follow-up discussions on these topics. Furthermore, I want to hear your thoughts. What specific junior miners or developers do you believe are best positioned to capture these exponential gains? Leave your comments below and let's engage in a constructive discussion about securing generational wealth during this unprecedented commodity supercycle. The time for decisive action is now.